Archana Mahendran, Head of Investment Strategy at HSBC as well, joins in on the show. Archana, hi, afternoon. The S&P revising its outlook lower for India. How do you interpret this warning and how bad could things get from here?
They famously, downgraded U.S. government debt last year. That, of course, did highlight the underlying problems in the U.S. government debt market. And similarly, I think in India, they have highlighted that the balance of payments is entering a difficult period, primarily because of the high cost of oil imports and weakening export revenues, particularly from the outsourcing sector in India, where you've seen that American corporations, the big clients of these outsourcing companies, are spending less on outsourcing activity, and therefore the export side of the Indian balance of payments is weakening to some extent. So the balance of trade is worsening, and this will be a strain on reserves in time to come. Now, having said that, Indian reserves, gross reserves, are about $270 billion, and that is very comfortable. It's over 5 months of imports, so I don't expect any significant deterioration in the balance of payments situation in the short term, i.e. the next 6 to 9 months. But certainly if the adverse effects of the recently announced government budget in India on capital flows, all these measures to introduce retrospective taxation on merger and acquisition activity in the past, and the prohibition of routing overseas remittances through so-called tax havens, all that sort of activity could perhaps mean that capital will flow out of India rather than come back in over the medium term. So that could pose some risk.
Okay. Arjuna, I just wanted to understand from you, IT, what would you do here? Because S&P revised their outlook on IT companies to negative, probably because of the sovereign rating coming down. How would you view the IT space?
Well, I mean, exporters in general are, I think, going to face some heavy weather, not just in IT outsourcing, but export in general across the whole of Asia, given the weakness in Europe. And remember, the combined European economy is still the largest economic bloc in the world, with a total annual GDP of about $16 trillion in nominal terms. That's bigger than the United States, which is about 14 trillion. So that weakness will definitely have an impact on Asian exporters, including these IT outsourcers. So I don't think IT outsourcers in particular are any worse off than exporters in general going forward. But of course, I will be cautious about exporters in general in Asia, and in that context, yes, I wouldn't really go overweight on IT outsourcing companies in India right now.
Archana, S&P has been very pessimistic in their estimate for India's growth. The finance minister has reiterated that they are very much on track for a 7% growth. What is your view on what we may do at the end of the fiscal?
Well, I think the growth in India this year will be backloaded into the fourth quarter. So I expect that the shocking 6.1% rate of growth printed for the last quarter of last year, that I think will continue. That pace, we will probably see 6.2 to 6.5% for this quarter and perhaps even the next. Given that the very tight monetary policy, the Reserve Bank of India raised interest rates 13 times before cutting it last week. That combined tightening of monetary policy, which effectively means that small companies have to pay 15% nominal rates of interest on their borrowings, that has really slowed down growth tremendously, and it'll take a few more quarters for that slowdown to work its way out of the system. But I think given that the Reserve Bank is now aggressively moving in the opposite direction, and we find that some of the high-frequency indicators, PMIs, etc., are suggesting to us at HSBC that activity is actually now generating more confidence, that I think could then mean that by the fourth quarter of this year, we expect economic growth to surge up to about 8.5%. And I think that will be a very welcome development.
Some analysts believe that the market has priced in all the negatives and there is less downside from here for India. So the opinions may vary, especially after what's happened with GAR. But would you agree on this? Less downside and all negatives priced in?
I agree. I think analysts in India, as is the case across Asia, have been downgrading their forecast for earnings growth over the last year. And I think now you see an inflection ahead. They're getting a little more positive. So I think we've hit the bottom in terms of downgrades.
So, Archana, what is your view on India in the second half of CY12? Will things change from the crisis of confidence that we're currently facing? And what sectors do you think could lead us out of this range-bound trade?
Well, I think the moment analysts get more positive on earnings, which I think is going to happen by July, then you will see more enthusiasm in terms of stock market activity and flows of foreign money into the market. And that will then lead to a general economic re-rating. We're expecting the monsoons to be normal and better agricultural production, etc., which is a big deal for India. So I expect that the second half of the calendar year is going to be better.
Arjuna, S&P says that there is a 33% chance of a potential downgrade in India. How realistic is the downgrade situation right now?
Well, S&P may well do that, given the balance of payments issues I pointed out. I mean, oil prices are the current big threat for India on the balance of payment side. And, of course, capital flows are critical. So if capital flows don't increase significantly, i.e. inward inflows of capital into the stock market, etc., which I don't think will happen till about July, then you could potentially see a downgrade by one of the rating agencies. But that would really not damage India's prospects, because India's bond market, frankly, is relatively small compared to the broader emerging markets in Latin America, etc.